You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. We've got a special guest on with us now, a devotee of the Austrian School of Economics and a retirement planner, diverse career. His name is Dennis Tubbergen. And Dennis, now you're a prolific author, run a hedge fund, and you're trying to help people understand how you get ready, how you plan for retirement. And your site, retirementlifestyleadvocates.com, is in furtherance of that. You've written books. Hey, if you had to sum up your retirement philosophy for 2023 and on, what would it be?
Well, first of all, Kerry, thank you for having me. It's a pleasure to be on your program. I think I would say that this is not your mom and dad's retirement. If you plan the way your mom and dad did or your grandparents did for retirement, using the traditional tools, using traditional strategies, it's my view that you will fail. And I believe that you'll need to take a different approach. And I designed an approach called revenue sourcing that really has you use a bit of an alternative approach given the current economic environment.
I like the sound of it. So what is revenue sourcing?
Well, in a nutshell, our economy is not healthy, largely because going all the way back and referencing the Austrian School of Economics, our money's not sound. It's hard to have a sound economy without sound money. And since the dollar became a fiat currency in 1971, all currency has been loaned into existence. By the time the financial crisis hit, worldwide, there was $100 trillion in debt. And now here we are about 15 years later, after all the quantitative easing, which is just another phrase for currency creation out of thin air. We now have $300 trillion in debt worldwide. So,
but we're richer now, though, right? Everything has gotten better.
Nominally speaking, yes.
We're borrowing ourselves into prosperity, but we're borrowing money like that we have no intention of ever paying back, right?
Yeah, and I mean, ultimately what we're going through, as Thomas Jefferson said, if we ever allow private bankers to control the issue of our currency, we'll experience inflation followed by deflation, to do a poor paraphrase. We're seeing that now. We're seeing the inflation, despite the politicians or some of the politicians taking a victory lap a couple months ago. The latest PPI numbers are out. Inflation is still a problem. It's accelerating. And it will accelerate until we get a deflationary reset, because as you and I both know, Kerry, if there's too much debt to be paid, it won't be paid, and there will be consequences when that reset happens.
Yes. But the Federal Reserve's kind of like their function is like the juggler at the circus, or the guy with the spinning plates. Keep as many of those plates spinning in the air for as long as possible, and don't let any crash. But they keep getting more and more plates. And it basically has become an impossible task, right?
I agree with you. I think the Fed is absolutely painted into a corner. There is no solution here. In my revenue sourcing book, in fact, if anybody'd like a copy of the book, I'd be glad to send it to them. They can go to revenuesourcingbook.com. I'd be glad to mail them a free copy. But in the book, I talk about the fact that the Federal Reserve cannot create enough currency to pay off the debt, and the debt cannot be paid through honest means. We've got just the national debt of $32 trillion is now $250,000 per taxpayer, and the median net worth of an adult American is $44,000. So I mean, the math dictates that there will have to be a reset, because this debt will be unable to be paid, and we'll end up in a deflationary environment. I believe that will look a lot like the 1930s before we get to the end of this reset.
All right. So the 1930s, and that was a very tumultuous time in this country's history. It felt like it was, if you were alive then, it felt like the country was coming apart at the seams. a lot like it does today, didn't it?
I think there are many eerie, scary, ominous parallels. If you look at private sector debt levels compared to economic output, we are at about the same level as we were in 1929. Private sector debt's about 235% of the economy today. That's about where it was in 1929. Here's the scary statistic. The government wasn't broke in 1929. Government debt to GDP was 20%. It's now at 130%. So to put it in simple terms, we're running out of room on the credit card. We're just about at our credit limit, and that's when the reset will have to occur.
And what do you think this reset is going to look like?
I think that you're going to see, given current Fed policy, my best guess, Kerry, is we're heading for a stagflationary outcome. So I think you're going to see consumer prices probably continue to rise. So that probably means more money spent at the grocery store, more money to buy fuel. At the same time, I think you're going to see asset prices decline. I think you're going to see real estate prices decline. I believe that looking at some of the numbers now in the Bay Area, which is kind of like the canary in the coal mine, the Bay Area of California, that is 35% decline year over year in real estate values. Stocks were down 20% last year. From the looks of the market now, I believe that we may be starting the next down leg, although it's a little bit early to tell. So I think financial asset prices decline in value, while the things we have to buy, the consumer items, probably continue to experience inflation.
All right, so stagflation. And so what are you supposed to do? How do you overcome stagflation? How do you make it your friend and not your enemy?
Well, because we don't know when this reset's going to occur or exactly what it looks like, because full disclosure, my crystal ball doesn't work any better than anybody else's. And the what is easier to predict than the when. I'm an advocate in the revenue sourcing book of saying, design an income map, figure out how much income you're going to need during retirement, do your tax planning, do your Social Security maximization planning. Once you come up with an income model and you've defined the target, then make sure you set aside enough money in a stable asset type bucket, if you will, so you can meet your income needs while this reset happens. You want assets that are not going to be affected as financial assets decline in value, but you need another bucket of assets that will perform well in an inflationary environment. And that typically means you want something tangible. So I'm a fan of having some gold and silver in your portfolio. I think if you look at the 50-year relationship between commodity prices and stocks, it tells you that commodities are extremely undervalued at this point. Stocks are extremely overvalued. So in that other inflation protection bucket, if you will, I like a link to something tangible.
All right. What about real estate, though? Now, one thing I've seen is inflation, all right, hotel prices are through the roof, even for what were mediocre hotels in place. I know you like to vacation. In Key West, they were $200 back 10 years ago. Now, garbagey hotels like 3-star, okay, not garbage, but not great. 3-star hotel, $500 plus a night. So it seems to me that the Airbnb craze is here to stay. It's not a fad any longer. And if you position your real estate properly, you can be the beneficiary of this.
I think that's true for the time being. I think that the ultimate question in my mind would be, or my perspective would be, that it just depends how severe this deflationary reset is. I think it will affect real estate across the board. I think it will affect stocks across the board. I view the exception to that as maybe farmland, because farmland tends to track the price of agricultural commodities. So I think, the VRBO business is solid now. I guess my perspective would be that we need to kind of wait and see.
All right. Well, that's interesting. So real estate going through an iffy stage right now with higher rates, of course, but not all markets are created equal. We have really over 1,500 different real estate markets in the country, but they all kind of rise and fall with the same tide. But in places like Florida, in Texas, in the South, Tennessee, the Carolinas, Georgia, you do have increases in population, largely as a result of people fleeing the less business-friendly states. Let's just put it that way. Does that continue? Does that insulate a Florida against real estate declines to some extent, or what?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, I mean, I think that, when I think one of Warren Buffett's favorite sayings is that when a rising tide lifts all boats, and when the tide goes out, you can see who's swimming naked. So I think that you're going to see real estate overall decline. But I think in states like the one I live in Michigan, I believe that the decline will be more severe than in Florida, simply for the demand reasons that you correctly point out, in my view. So. But I think it's, if I was in if I had real estate to sell now, and I sold it, I would be keeping my powder dry before I went out and bought more real estate, because I think we're seeing the beginning of the decline here.
All right. And we saw, especially in light of the pandemic, but really since the Great Recession, the last Great Recession in 2008 and 2009, once the recovery was firmly in place, which I would say was 2012 to 13, real estate just went straight line up. So you think now we've got to have somewhat of a correction or pullback to straighten out, rationalize that market?
Yeah, I think so. And, when you look at a bubble on a price chart, whether it's a tulip bulb price chart from the early 1600s, or the Mississippi Company from John Law's France in the 1700s, or the recent real estate price bubble, I think that you see that the bubble, as it builds, goes almost parabolic. It goes almost straight up, and then it tends to take about as long to unwind as it does to build. And I think we're just seeing the beginning of that unwinding. And I've got to, it's my view that real estate prices will have to go back to where they were pre-pandemic, pre all the government stimulus, pre-CARES Act, pre-Secure Act.
And so do you value real estate then as a multiple of income? Normally, historically in the country, 3 times your net income, or 3 times your gross income, rather, that would be approximate price that an average home would go for. Are we heading back to those days? Right now, it's like 5 or 6.
Yeah, and I think that 5 and 6 multiple is only made possible by 30-year mortgage rates under 3%. So that goes back to the fact that we've been living, I believe, since the financial crisis of 2008 and 2009 that you referenced. I think we're living in a very artificial economy. And now I think we're starting to move back to reality, with the Fed now, increasing interest rates to try to get inflation under control, which I believe they're not doing enough. But we're starting to see glimpses of reality. And I think we're going to have to go back to that, because, what made a house that was worth $150,000 15 years ago now worth $500,000? I mean, it's the same place to live. It's got the same square footage. The only reason that happened is that we have much more favorable buying terms and lower interest rates and stimulus money. We've built the bubble through the policies that we've been pursuing collectively.
Right. And this return to normalization of rates, maybe the government debt, maybe we can't afford to, but we can't afford not to anymore. 0%, 1% rates, and, lowest rates ever. I think my father, when he took out a mortgage on the house that he built in New Jersey in like 1963, he had a small mortgage. I think it was a 3 or 4% mortgage back then. And that was before all the inflation, or much of it, took place, that was going to take place in the 60s, 70s, and 80s.
Yeah, I mean, I think that, as it relates to government debt also, I mean, that this is a really scary stat. when you take a look at where just a year ago, where was what was the interest rate on a 2-year treasury? I mean, you were 2.3%. It's now 4%. Well, finance $32 trillion at 1% versus 4% to do just some very quick math. And it's $1 trillion more for debt service on 3% interest. So that's another ticking time bomb that's going to have to explode at some point. So it's for that reason, I believe the Fed is going to be forced to pivot. They're going to be forced to reduce interest rates. And I think that's going to lead to this stagflationary outcome.
Right. And so energy, you an energy bull?
Energy bull for sure. It's first of all, it's commodity related. I think that, when you just take a look at, the worldwide conditions, I believe long-term oil is a good place to be. Energy is going to be a good sector to be in. I think a broad stock market approach moving ahead probably doesn't serve aspiring retirees very well, but I think energy is a sector that will do well.
All right. So we like energy. We like precious metals. What's your feeling like? So we talk commodities. You think copper is going to blast off again? And, all of those commodities that right now the inflation rate appears subdued, but maybe it isn't.
Yeah, copper's not a market that I am involved in. So I'm going to politely pass on the question because I don't really have a strong opinion, but I'm very bullish on gold, and I'm even more bullish on silver as far as metal commodities go.
Okay, so gold and silver, we like them as well. And, food. What about food? Obviously, it's tied into the price of energy, tied into the price of oil and natural gas because fertilizer is extracted from feedstocks of nat gas and oil and other commodities. So got to be a bull on food if you're a bull on energy.
Absolutely. And for the reasons you outlined, I would totally agree with that. I think some of the, some of the futures we're seeing, some of the agricultural futures prices are validating, the logic that you just recited.
All right. Well, we agree on too much here, Dennis. It's starting to alarm me.
Well, a couple of libertarian Austrian economics guys are probably going to agree more than they disagree.
Yeah, hopefully.
Yeah. Well, I would if it's okay. I'll let any viewer or listener know that if they want to get a copy of the revenue sourcing book, they can go to revenuesourcingbook.com, and I'll be glad to send them a free copy.
All right, and we'd love to get a copy too. And
I would gladly send you one.
Dennis, where's the best place to find you these days?
If you go to revenuesourcingbook.com, all my contact information's there. You'll get a free book. Otherwise, you can go to retirementlifestyleadvocates.com, and the contact information is there also.
All right. Hey, look forward to reading the book. I'm shooting you off my address right now. You can send me the PDF if that works better. But either one, we want to take a close look because I haven't heard anybody put it quite like that. Yes, cash flow. Yes, I get it. But it all comes down to how much money you put in your pocket at the end of the day. And for certainly retirees, which maybe one day I'll have the luxury of becoming, it's more important for retirees than for younger folks, because younger people in your 30s, 40s, you blow through your money, you can make it back again. I've done it at times myself. I always say I've made 5 or 6 fortunes, and five fortunes. I've lost 3.5 of them, and I'm a lot more the wiser for it. So, hey, if you got a question for Dennis, which I hope you do, shoot us an email, kl@kerrylutz.com. Write your comments below on the YouTube channel if that's how you're seeing us. And make sure you go to the site, financialsurvivalnetwork.com. Sign up for your free newsletter. Dennis, been a total pleasure. Keep the faith, and we will have you on again.
Love to do it anytime, Kerry. Nice to chat with you. Thanks.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.